The number of headlines in the last 10 years that would have convinced you to sell all your stocks, put it in cash, sit on the sidelines, and wait for the storm to blow over is easily going to be in the hundreds. So is right now a time to believe what all the bears are saying, sell all of our stocks and actually put them in cash? Or is it a time to go against the grain and potentially capitalize on one of the biggest stock market opportunities that we're ever going to see in our entire life? So in this video, I'm going to show you 8 different charts that are going to give you a clear picture of what's actually going on in the market right now and exactly how to capitalize on this. Because remember, I'm here to make money. You're here to make money. Don't like, don't subscribe. I don't care what you guys do with that stuff. I just want to make money and I want to present this information to you guys so that you can make money too. So I always like to start off on a fear greed index because this gives a very good picture of the sentiment in the market right now. And the reason why this matters is because historically speaking, investors are horrible at investing their own money for themselves. So when people are fearful out there in the market, this is when a typical average Joe investor is selling their stocks and they're freaking out because the market just has a lot of turbulence going on right now. There's tariffs, there's recessions, there's inflation, there's stagflation. There's a lot of true fears on the horizon for the stock market. And what the typical average Joe investor does is they sell. When they sell, the stock market goes down, things go on sale, and this pushes the needle towards the fear and extreme fear category over here. And it's pretty crazy because the market did actually go extremely fearful and it went down to a level of 4, which is historically one of the lowest readings that we've ever seen on a fear greed index ever. So there's a lot of bearishness in the market, but everybody wants to know right now, we're going towards the right and this is getting towards the neutral category. Is now a good time to buy into the stock market? And remember, there's 8 charts that we're going to go through that are going to give you a crystal clear picture of the state of the stock market and the most likely situation that the market's going to do in the near term and the long term to ultimately know what to do with your money definitively for yourself. You're not going to let a news headline sway you. You're not going to let someone on YouTube or X tell you what to do. You're going to know definitively for yourself as an investor, what do I do with my money, and have confidence doing it. That is what this is all about. I'm going to be honest, I was debating throwing this chart in here because remember, I only want to give you guys the true value that actually matters, but I do think that this chart matters a lot after I put a lot of thinking into it. And the reason being is this. From 1996 to 2015, the average investor underperforms the stock market by quite a bit. You can see over here on the right-hand side, the average investor does 2.11% per year annualized in this whole 20-year time period, but the stock market does 8.19%. So why are the average investors making so much less than what the actual stock market is doing? And it all comes back to this chart right here, the fear greed index. People let their emotions get the best of them in the stock market. When people are greedy, this is a time to be fearful in the market and potentially sell your stocks. And when people are extremely fearful, this is a time to buy into the stock market. So my question to you, when the stock market was in this extreme fear category over here just a few days ago and a week ago, were you buying into the market? I was personally buying into the market. The people that went through my course are buying into the market. The people in my Discord are buying into the market. But are you buying into the market? You need to deploy a little bit of capital when there's so much fear in the market in this category over here. And just look at it. Bonds, gold, international stocks, homes, oil, inflation. The average investor doesn't even beat inflation on this 20-year time period right here. How is that possible? I think this chart gives a little more clarity on how that actually is possible. So the blue line right here that goes up and down like this is the fear greed index just plotted onto a chart, and then the orange line corresponds to the S&P 500. So let's take a look at this on a very microscopic level and really understand what we're looking at here and spot a trend that if you just invest at a certain time when the fear greed index is at a certain level, typically you'll do pretty good. So over here on the right-hand side, we went all the way down to a fear greed index level of 4.53. That is very, very, very bearish. Going back to the chart, remember we're at 31 right now. So the market did rebound quite a bit, and that's why we're at 31 and not 4 anymore. So sentiment is going up as the market's going up. So it's kind of funny how that works. Just because the market's going up, that doesn't necessarily mean the economy is doing better. It just means the stock market's going up. So the typical average Joe investor is simply more optimistic about the stock market only because it's going up. In theory, for me at least, when the market's going up, I'm getting less optimistic about the market because the market's now becoming more expensive. Now, of course, the market does deserve to go up sometimes. Obviously, when earnings go up, interest rates go down, inflation comes in good, stuff like that, the market obviously deserves to go up. If we make a trade deal, stuff like that, that is all good news. But in a nutshell, when things get more expensive, I am more bearish about it. So if we just take a look at how low we were on the fear greed index recently, just a couple of weeks ago, and we correspond that to all the lows that we had in this time period over here, you could see May of 2022, the fear greed index went all the way down to 3.2. Now, if I keep this line right here, just go up, and you can see the stock market is pretty close to a bottom. I know it's not a perfect bottom right here. This is the bottom right here. But the point I'm trying to get at is this. When the fear greed index goes very low, it indicates bottoms in the stock market. This was pretty close to the total bottom right here. This one right here did correspond to the bottom. So taking all that to the right-hand side of the chart, it is very, very possible that April 4th of 2025 was the bottom of the market and the lows are in, and we're only going to go up from here. Now, is that possible? Of course. Is that guaranteed to happen? Definitely not. But odds are pointing to that the bottom for the market for 2025 are already in. And by the time I show you the next couple charts, you're going to know definitively if the bottom actually is in or not. And I'm going to give you clear logic of why, logic that Warren Buffett uses when he evaluates the stock market and individual companies. Because when you understand this stuff, things become a lot more clear. And the post that I did today on Twitter actually fits this video pretty well. And I talk about how the market climbs a wall of worry. There's always something to be scared of. There's elections, there's wars, there's rate hikes, there's recessions. But if you're waiting for the fear to go away before you invest, you're going to be waiting forever. There's always something to be worried about in the market. The market is never going to be this picture perfect scenario where you invest your money into it and the market happens to be at a very discounted level. It's never going to be like that. When the market is at a discounted level, that is typically a time that the market is extremely fearful. And you're going to say, oh, well, inflation's coming back. Oh, well, we're going to have stagflation. Oh, the trade war is going to last forever. That is a time that the market usually bottoms out. Remember, the market is a machine that tries to price good news and bad news into the market, and then it reflects that in the stock price instantly. There's hedge funds, there's high-frequency traders, there's retail traders, there's institutional investors. There's people that do this all day long that just try to price things into the market and try to get a little bit of an edge. So the point that I'm trying to get at is this. The S&P 500 has averaged 12% annually over the last 50 years with all of that fear along the way. Just think about that. All the bad things, all the good things that happened in the last 50 years, the market still managed, you can see it right here, it still managed to do 11.95% in the last 50 years with dividends reinvested. So the market moves through all the worry and most people miss it because they're too focused on the headlines and wait for the perfect moment to invest. Analysis paralysis will destroy the average investor. Please don't let it destroy you. Remember, there's never going to be a perfect time to invest. You're never going to feel 100% confident. Warren Buffett is never 100% confident when he invests in something. It's just a game of doing your research, understanding the company on a very deep level, and putting your money where your mouth is, and then being patient. When you do stock options, only do stock options on ultra high conviction plays. Don't just go do stock options because someone on X said, oh, go buy call options on SoFi or Celsius. You really got to understand the company for yourself to know what you should do. And the reason why I say that you have to build your own confidence for yourself is because if you look at this chart right here, you're going to know what I mean. So this chart goes from 2010 to 2017, and it's basically just some random negative news headlines that came out, and some of them are from some very big hedge fund managers like Carl Icahn. 9/30 of 2015, he said that danger is ahead in the market, and notice the timing of when all these negative headlines come out. When the market's on a dip. But when the market's going up, there's not many negative headlines up here because it's hard for people to talk bad about the market because it's not the popular thing to do. But when the market is going straight up, that is actually the real time to talk about negativity in the market because the market's getting expensive. But when the market's going down and getting cheaper, that actually is the optimal time to come out and say, hey, I think we should get bullish right now because things are on sale and there's extreme fear out there in the market. And when there's a lot of fear out there, you guys know that I like to sell put options. When you sell put options, somebody on the other side of the trade is buying that option from you. And when there's a lot of fear in the market, people are willing to pay more money for those put options. And when they pay more for them, I'm selling them for more, so I'm making more money. All when the stock market is cheaper, when these stocks are cheaper. So it's safer to sell puts on these companies. But just go back and look at a few of these headlines. I mean, this guy right here said he predicts a 50% unemployment rate and a 90% stock market crash, 100% inflation starting in 2016. Did any of this actually play out? Go and look what the actual S&P 500 is at versus right here what Mark Faber said in 2016. He thinks the S&P is going to go all the way back down to $1,100 per share. Do you want to know what the S&P 500 is at right now? Yeah, over $5,400 per share. So listening to any of those people on this list right here, you would have gotten smoked. And if you didn't have conviction in the trades that you made, you would have paper handed out. You would have sold your stocks at the bottom because you didn't have conviction. You didn't do your own research. You didn't know what to look for. You just didn't understand the companies that you were investing in. So the more that you know, the more conviction that you're going to get, and you're going to understand what to do with your money even better. you're going to become a much more patient, much more seasoned, much more emotionally stable investor because you're going to sleep well at night, knowing that your money is in the right place and that short term the market is irrational. And when the market's irrational in the short term, that is a very, very good time to capitalize on the dips that the market gives us. So I have 3 charts left that are ultra mission critical to know exactly the state of the stock market right now and to know definitively what we should do going forward. If you understand these 3 charts truly on a very deep level, you will do fine in the stock market in the long run. If you don't understand it, you will not do fine. So let's take a look. So chart number 1 is the federal funds effective interest rate going all the way back to 1980. So right now we're at 4.3%, which is down in this level over here. But you can see in 1980, the federal funds interest rate was at 19%. I know it sounds absolutely bonkers to talk about that because 19, it's like, oh my God, the federal funds interest rate was at 19%. You could go get a 19% CD at the bank. You could go get a 19% loan on a house. You could go get a 19% bond. It was absolutely insane. But why were interest rates so high? They were high because inflation was high. When inflation goes high, the Fed will usually raise interest rates to try to slow down the economy. So when the economy is slowing down, the businesses in the stock market aren't making as much money. And when they're not making as much money, those stocks look less compelling. And when those stocks look less compelling, the PE ratios on those stocks are going to fall. And the reason why those PE ratios fall is because you could go get a guaranteed rate of return of 19% in a bond. So the stock market is very uncompelling. And just to prove that, this shows you the PE ratio since 1980 of the S&P 500. And you can see in 1980, it was 7.61. And all the way on the right-hand side right now, it's 27.33. So yes, the PE ratio is much higher right now, but take a look. Interest rates are much lower, all the way from 19% to 4.33%. And I am personally in the camp that interest rates are going to fall because inflation is going to fall. And the reason why I feel so confident that inflation is going to fall going forward is because I feel like we're on the brink of a massive tech and AI revolution. So as AI continues to get better and better, efficiency is going to keep going up at these businesses and productivity is going to go up. When productivity goes up, the amount of money that the business makes go up, the profits. When the profits go up, the earnings per share goes up. And when the earnings per share goes up, guess what goes up? The stock price. So I think it's a very bullish setup for the stock market. And remember, the VIX, the volatility index, is very high right now still. And when the VIX is high and when you have so much negative news priced into the market, and you have this massive AI and tech revolution that's just coming, the tidal wave is just coming over us, I think it's a really good time to start deploying capital. But we have to look at the last chart right now to understand if the timing of the market right now, if it's the right time to put your money into the market, or do we wait a little bit longer and maybe catch a little bit more of a dip? Let's take a look. So I talk about this chart quite a bit on this channel, and I really only want to give you guys the stuff that actually matters. Remember, we're all here to make money in a no BS way. This chart right here matters and it's ultra critical because it just updated and we have to talk about what changed on it. So the blue line corresponds to the S&P 500 and the darker line, the black or bluish line, whatever you want to call it, corresponds to the actual earnings per share of the companies within the S&P 500. So as you guys know, the stock market follows what the earnings do of a company. If a company's earnings go up by 100%, expect the stock to roughly go up by 100% with all other factors remaining the same. I get it that there's other factors, but in a nutshell, the market and the stock will follow what their earnings do in the long run. So this is a 10-year chart right here. You can see the lines kind of start in a similar spot on the left-hand side, and they're kind of ending in a similar spot on the top right. And you could go back and watch other videos on this channel. When the stock market was all the way up here, I was telling everybody the stock market was overvalued and these two lines are going to touch again. So whether the stock market goes down or the earnings go up, these two lines are going to touch. It literally panned out literally like a month or two after I talked about it. It's crazy how it worked out so fast. I honestly didn't expect it to go down that fast, but it did. The market did fall pretty sharp because it had a very negative catalyst, the tariff stuff, to fall that sharp. Liberation Day was a lot worse than many people thought, and the market went straight down. It wasn't priced in yet. So the point that I'm trying to get at is this. If we go back to 2022, you could see that the market was quite a bit of ways above the earnings per share line. The market corrected down and actually went down below what the earnings per share line was. Now going into 2024, towards the end of 2024, you could see there was this massive disconnect right here, pretty much the biggest disconnect that we've seen in 10 years. I was warning people, the market is overvalued. But now that the market fell, you can see the line went down, and it's very hard to see, but the line went down at the S&P 500, and it went back to the tip of my cursor right here. So the distance from the tip of my cursor from here to here, this is the distance of overvaluation in the stock market. So if we say that the true intrinsic value of the stock market is right here because that's where the earnings line is, we go to the left and we say that this is the $5,100 S&P 500. Remember where we're at right now, 5,484. So the market is a tiny bit overvalued right now. But there is one thing that if you're a good investor, you'll understand and you'll know this, because every good investor tries to poke holes in what they're talking about to say, well, what is someone going to say and talk crap about what I'm saying right now? You have to really understand every side of the story. So what are the bad things about this chart right here? Well, it's forward 12 months earnings per share. This line right here is forward 12 months earnings per share, and you can see it's pretty much flat. So earnings per share is expected to be flat for the 12 months going forward. But what if they actually grow pretty good? When they grow pretty good, when the market rebounds a little bit, sentiment's going to come back to all the analysts, sentiment's going to come back to the CEOs, and they're going to start guiding maybe a little bit more bullish because I think the economy is going to be a little bit stronger than what they originally thought. So this line is going to go up. So if the earnings per share forward line goes up, that means the stock market could run up a little bit more. But there could also be negative news that comes out from China, from trade wars. Maybe inflation goes up. If that happens, maybe interest rates will stay higher for longer. That could be bad for the stock market. If that actually pans out, the market's probably going to go down even more. So you definitely don't want to have too much option leverage right now, like stock option leverage. But if you do it on ultra conservative plays. If you're selling puts, make sure your strikes are quite a bit of ways below the money right now. On companies that you're okay to hold for the long run, that are cheap, that have a durable competitive advantage, and it's just a quality company that you're okay to take assignment of if you happen to go into the money. Now, buying calls is much harder because you need the stock price to go up and go up quick. Selling puts, you have a lot more flexibility. And when in doubt, just go back to this chart and understand that the market is very close to MSRP, meaning intrinsic value. But in 2022, you could see the market was quite a bit of ways below what the actual earnings line was. So the market was very cheap right here. So it was very obvious to go buy into the market, do calls, sell puts. But over here, the market's just neutral. So if you want to learn how to invest your money the right way in the stock market with stock options, click the link below and do my course. It's going to totally change your life. I scaled to millions of dollars. I have hundreds of people that went through this course that are scaling too. I generate thousands of dollars every single month with stock options, all in a very low risk and conservative way. Click the link below, do my course. If you don't want to do that, watch this video right here. It's a little bit more detailed of what I do with stock options. I'll see you guys there.